Okay. It's a lovely day again, and welcome to this podcast. I'm with my usual guests, usual suspect, Sidi. How have you been?
I've been excellent. I've been excellent, my man. How are you doing, okay?
Very well, very well, and great feedback about the podcast that we had last week. Excellent feedback with respect to the issue of bank loans.
No, we are extremely humbled that there's some value seen from what we're sharing.
Excellent. Today we are back with an exciting topic, and we continue from the discussion that we had on borrowing. Of course, we know that businesses borrow for different reasons. Some businesses borrow to expand their business operations. Some business borrow to fund their working capital needs. Some businesses borrow because they are stressed, and many businesses borrow for different, reasons. But just to share, what, in your view, are the key reasons why businesses borrow, and what motivates that intention to contract debt?
Thanks, okay. So maybe I will just wind it down a bit and look at it from the issue of answering the question: can you actually scale without debt? Okay. So that we set the stage of is debt a prerequisite for growth, for any meaningful growth? And the answer is actually yes. And there are so many examples. I would start with just a simple example. If, say, you have an asset, let's reduce it to even like a small thing so that numbers are easy to. You have an asset which is worth 50,000 or 500,000, as an example. And you want to acquire that asset as part of, or you want to get that something as part of whatever. There are two options. You can either save for it. It will take you, depending on how much you can save, it will take you quite a long period of time. And that's what we call equity. That means you have equity into that aspect. So that will take you a considerable amount of time. Say, for instance, you're able to save 50,000, then it means you have to save you are able to save, let's put it into months. You're able to save 50,000 a month, then that will take you 10 months. But if you decided, okay, let me actually go and borrow, so I can generate 50,000. Let me go and borrow so that I can buy this asset now, and then I'll be paying the 50,000 down the line. So if that asset is actually even income, so you can see that that's where debt comes in, like leveraging debt comes in, because now you can use your income, the same income potential. On one hand, you are going to save, and the unfortunate thing with saving is that over the period, I've just used months here, so it won't make a big difference when it comes to inflation. But when you put it into years, over that period, say if we said it was 10 years, by the time you get that money, inflation is the eater of everything. So that's why I say inflation punishes the saver. Yeah. So that's why that money needs to quickly be turned into something that also appreciates, like in form of an asset. So that's where debt comes in. That it compresses the time. It compresses the time for you to take control of something, and then you can continue. Yeah. But of course, it's not. It doesn't come at zero cost. There is a cost, and there are some risks that have to be. So you can see that, therefore, for any sustainable, especially for business, And here we're talking about growing businesses. If the growing businesses are going to grow and take advantage of the opportunity, because an opportunity will never be there forever, right? Then it means debt is imperative. They need to have debt. Otherwise, it's not going to work out. That growth is not going to happen, and the opportunity is going to go, and there will be stagnation. In fact, there is effectively no stagnation in life, because if something is not growing, then it's dying. You can even see it from I'm very, very inspired by our big brother, Nigerian Dangote, Aliko Dangote.
Yes.
He picked on, he's been growing steadily, but now he's reached a stage where he wants to transform Africa as the land of opportunity. So he's done the first refinery. It's actually the biggest in the world. How did he do that? Yes, of course, he had quite a bit of his own money into it, but he couldn't have put that project off without the support of development partners. So he had to go and get debt into to leverage, so that then he's been able to even expand and go into all these markets he's going into right now. He's also working with the East African colleagues, so that we can have another refinery, in there. So the long and short of it is, debt is imperative. It's a must. If you want to grow and grow sustainably, especially in a market like ours, and in fact in any economy, you need debt. But therefore you need to know how to manage it and leverage it.
Excellent. Well put, CD. There is also, empirical evidence that all the successful companies and corporate, some light about the successful companies that have grown, and there's evidence that their growth was driven by the borrowings. Just a few examples. I know you gave the example of Dangote, but we have a number of examples out there.
Yes. I mean, we can even come here local. I mean, look at all the companies, including the ones that are listed. They all have a significant portion of their balance sheet is actually debt, in terms of how they've been able to finance. Zambia Sugar, Zambif, and for me, if you look at any balance sheet, the issue is just how sustainable is the debt that they have in there. But otherwise, you notice that any corporate of any considerable size, when we look at even most of our clients, you find that the issue of debt is a key aspect. Is a key aspect to their growth. So it's one skill, but like we said the other time, it's like fire. It can, or even fuel. It can.
Yeah.
It can fuel. The fuel can drive you faster, or you can waste it, and it can even burn things and things like that. So that's why it's very imperative that we develop the skill of how to manage and manage debt.
Yeah, in managing debt, CD, the person borrowing has to have sufficient generation of cash flow in order to sustain the repayment of debt, and of course the business has to generate robust margins, make sufficient profits. Just weigh in on the issues of generation of cash flow, robust margin, reinvestment of the margins into the business, and how this obviously impact on any person intending to borrow.
Excellent, excellent. And maybe before I go into those numbers, I think there's a fundamental imperative when it comes to debt. It's the issue of intention. The purpose for which you want to borrow is very, very important. And you are right to have talked of all those things, because those things now emanate from that aspect. So one imperative on debt is this, and this is for personal as well as business, is that never borrow for consumption. Always borrow to increase capacity. To generate what? To generate value.
Value, yeah.
So the first question is, why am I borrowing? Yeah. If you are borrowing for something, then you can't see how your capacity, and it's merely just to make you comfortable right now, then it means you have missed the plot. For me, that's where then debt becomes unsustainable. And that's where that thing of the Bible, when it says the borrower is a slave to a lender, for me, I think God referred to consumption debt. Because if you invest your debt into something that will not generate value, income for you going forward, then it means you have to work to make those payments. So it does not create the capacity. So you become a slave to that. And that's very, very important. So always, always, always borrow only because it's going to increase your capacity. Therefore, you need to look at the time I have finished paying for this debt. What capacity will I have created for me to earn more? Yeah. So that's very, very critical. Because the danger with life is there's what we call lifestyle inflation. So when our income grows, it's psychological. When our income grows, maybe even because of social circles and comparison and whatever, we also want to grow our cost base. Yeah. But that is a recipe for
Welcome back, Sidi.
Thank you. Sorry, we had a technological glitch.
Yes. We didn't borrow any bundles, did we? So yeah, we can pick it up and continue.
Yeah, absolutely.
So you were explaining on the intention, and I think well explained on the intention is something that you wanted to add, that the intention must be the right one.
Yes,
for
the
you
intention has to be right. So I think the long and short of it is, let's borrow to build capacity and not for consumption. In a business cycle, for instance, it breaks my heart when I go through and I find, why are you borrowing? Why are you using your overdraft? And somebody says, no, my salary bill was due and we were not able to, so we use the overdraft. That is a recipe for disaster. Because in a business context, salaries are a consumption. Because there is no future capacity you are creating. You know, we always pay for salaries for services that have been rendered. So if you are borrowing to pay for salaries, then you are in trouble. Okay? You want to upgrade your head office, and you go and borrow to do that, then you are in trouble. Because that is, there's no earning capacity. Yes, you might enhance the appearance and everything else, but there's no earning capacity. So monies, you have to borrow so that it goes into increasing the capacity to generate. So buying plants or investing in the machinery that will produce more, for me, then the debt is worthwhile, because by the time you finish paying off the debt, usually the asset will end for a period much longer than the debt, and therefore you have created more capacity to grow, and therefore using your debt. So that's why that's number one. For me, it's an imperative. Because if you don't do that, then debt is going to work against you instead of for you. Yeah. And now coming to the issue of the numbers. It's very important, one, to understand the difference between margin and cash flow. So when it comes to the bank, yes, they are interested in margin, but what they are more interested in is your cash flow and the quality of the assets that you have. Why is that? Because from the bank's point of view, all they are interested in is your ability to pay. And should you fail to pay, they want to have security that the assets that you have, if they were to sell them in a forced sale, then they are able to recover their monies. So those two are, so that's what the bank is interested in. But you have to be interested in margin, because margin is what builds cash flow, health cash flow. Yeah, going forward. So for me, but the two are actually different, and so for the borrower, you need to understand both. I can give an example. You can sell something, say at a margin of 30%, right? And maybe you sold it for 100, 30% is 30, or 100,000, 30% is 30,000. That is your profit. That's your margin, right? But cash flow is how much is that is paid out of that 100. Okay, because if that 100 is paid maybe in installments, where they are paying 20, 20, 20, 20, or they are paying in 2 installments, 50, 50. So you can see that there's those two are different, because the cash flow is what now helps you meet your debt obligations. It's not your profitability. Your profitability is an indicator that going forward you're a safe bet, but your cash flow is what is critical. And those two need to be watched. So you need to measure those very, very carefully. And in fact, it should be done before you contract debt, so that you can see what's the impact of the debt the debt obligation will bring in terms of, one, my profitability, and then two, do I still have a good buffer in my margin, and then two, do I have the cash flow to meet this amount of debt? Yeah, so that you can even do some scenario analysis where you say, okay, if worst case scenario, if this went down and this didn't happen, what would be the impact on my ability to pay? So that you factor in. So if you see that the amount of debt that you are getting is just like, it can only work if things worked out perfectly, then probably you are borrowing too much. You need to reduce that, so that then you can manage. But that needs to happen. You need to understand those numbers before you even get into debt.
Excellent. Now you mentioned something that is important. You are borrowing too much, maybe you are borrowing too little. What are some of the things that a borrower must take into consideration when determining the amount to borrow? Is it driven by a particular need, or is it driven by the ability to repay, or it's driven by both? What are some of the things that a borrower must take into account when making that decision?
Yeah. So for me, the first is what is the earning capacity that you are going to get for what you are using the debt for. That's number one. Okay. Then you can compare that with what it is going to cost you. So you need to know because the banks are not they are not charitable organizations. They are a business, and the way they make money is they've got money, other people's money on which they are paying interest, and they are charging us. They are charging us interest. The difference is their profitability. Okay. Okay. They factor in even other things like their operating costs and everything else to come up with how much they charge us as interest. So you need to understand, first of all, am I going to earn? Is my capacity going to give me a much bigger return than what I'm going to pay? This is where that's the first thing you need to do. So over a period that you can reasonably come up with numbers that are reliable, you need to say, okay, so what's the impact? So that then you can see the affordability. And you need to have, and the bigger the margin, the better. The bigger the margin, then the better the more your affordability is. But the lower the margin, then the lower, then you have to reduce the amount of debt you need to deal with, to contract on. Because the issue of the debt and why you have to be very careful how much you take is that it's also a reputation game. So we build our reputation very slowly, but it can crash
Overnight.
very, very quickly. And our reputation in terms of the debt cycle is actually currency down the line. Over time, it gives you very good leverage, because if you have a very good credit history, you meet your obligations, and everything else, it helps you become the most desired. Remember, the bank is looking at the risk. So if you can build a good reputation on repaying loans, then the banks will actually reach out so that you can negotiate. It's power in the future. So that's why it's very, very important that you maintain the relationship and don't overborrow. So I most of my clients, I even advise them, I know you are capable or entitled to this, but always never go for the full extent. In fact, for me, I always suggest maximum go to 70% of what you can, so that the other 30% is you putting in your own resources. Yeah. And 60-40 is even much better, because then it means you maintain your relationship. Then in the future, you become the ideal person where banks will be following you. And that's where now banks become partners in growth. Yeah. They come to you, you borrow because you want to, and not because you have to.
Excellent.
Yeah.
It's something that you've said several times, and I just want you to emphasize on this point. You've said a number of times, previous discussions, that don't borrow for consumption. Borrow to finance an asset, whether it's fixed assets or current assets. Yeah. Why is that important? Because we give an example of an organization borrowing to finance salaries. A service that has already been consumed. Now, just dwell on that particular why is financing an asset is important for the business?
Yeah. So it goes back to the issue of, are you using debt to grow, or are you using debt to become a slave? So if you don't use it to grow, then it's a very dangerous tool. It's a very dangerous tool, because it will reach a point where your affordability, because effectively what you are doing is you are saying you are going to use other income to manage that debt, because any debt obligation comes, I mean, any debt contracted comes with obligation. And sometimes the worst thing about debt is that, because it comes, even the usage sometimes, like you feel like it's not even your money. But at the end of the day, that's your money. You are obligated to pay it back. So if you don't create capacity, then, and unfortunately, whatever our current earning capacity is right now is diminishing. Yeah, it diminishes over time. So that is going to diminish, and meanwhile, the obligation is still going to be there. So that's very, very counterproductive, even on a personal level. It's a serious no, because then that's a clear way of you becoming a slave, an employee, where you start working for the bank instead of the bank being a partner for you, for your growth. Yeah.
Excellent. Sidi, it's always good listening to you share this financial information. Just briefly, your parting shots on contracting debt. Just your summary, and to the business. Word of advice to the business. The keywords in your parting shots.
Yeah, my parting shots really is preparation. Preparation is very important. So don't contract debt as a knee-jerk reaction. No, think about it, analyze what risks you are getting, analyze what the impact is, because you're going into an obligation which would actually either empower you into the future, or it can destroy your future, or it can turn you into a slave. You contract too much debt than you can afford in the future, and then you break your future opportunities. The banks won't even want to deal with you, and bad reputation goes much quicker than good reputation.
Good reputation.
Yeah. So they will just say, no, this is not the person. And then when opportunities, and like we've already said, you need debt to actually scale anything in that's meaningful. So don't destroy your reputation or capital on short-term satisfaction. So for me, that's the most important thing. Let's prepare, and this is what we do, what we are peddling right now to ensure, and especially focusing on the growing businesses. We want to be there to support, to give you clarity, yeah, to ask you the hard questions even before you approach the bank and say, okay, this is what you want, but let's work together in this. If this happened, where will the number sit? This is where you sit. We can give you feedback, so that even when you're contracting, you're going there, armed with knowledge and knowing that it's a strategic move. It becomes strategic contraction of debt, instead of where it's just hit and miss kind of scenario, which can be very dangerous.
Excellent. Obviously, talking of which, we rolled out a free app, self-assessment, bankability self-assessment. Great feedback from the public. And people have been asking me, why is this application free? It's so good. The logic behind that free app, and the intention to give it to the businesses so that they self-assess themselves before approaching any financial institution. Just what is the rationale behind the free app, and the advantages of doing a self-assessment before you approach a financial institution?
Yeah. No, we're so excited about that and feel proud that we've contributed something. I know I was looking at some comments where they're saying, as long as you're not guaranteeing us money, then this is useless. But what we want is we want to make sure that we reduce the friction. First of all, it helps somebody start thinking in terms of at a very basic level, what it takes to contract debt. Most of them, most of these applications, they take too long to be. The decisions take too long,
yeah.
and they even end up missing the opportunity, or even end up going into the Shylock debt, all because the right kind of because the bank has to go through some procedure. So we what we're trying to do is to make sure that we can help reduce that time. Because if you can go to the bank prepared with all that we have put in the tool, then you stand a very good chance. One, it gives you feedback on whether you are fundable or not fundable. And then two, it tells you if you are not fundable, is this fixable, and what it takes for you to fix it, so that you can very easily then, and we can assure you, if you can, because we've actually based it on a very comprehensive, high standard of documentation required for banks to make decisions. So you find that if you have all those issues there, you give it to them. It's a very quick decision. For me, there's value in decision making in terms of whether it's a yes or no. Either way, it helps you move in terms of your options and get to the people that are there to really help you, instead of wasting time hoping and then only to be told, it can't work out because this or this or this or this. Yeah. So that's why we've put in things like the kind of turnover you have, the number of years you have, whether you have security or not, is it verifiable or not, do you have any issues? So it's I would encourage everyone, even those that are not looking for debt, I would encourage them to take the test and just see. Maybe it's just some housekeeping. For me, it's good to be ready, so that should the opportunity come when you need to, then you can just purely just move on. And we are there to support in making sure that you use debt strategically, instead of a hit and miss that we've seen, which is catastrophic.
Excellent.
Yeah.
Excellent. Sidi, as usual, it's always good to have you on this podcast. We continue next week again with another exciting podcast. Thank you so much for coming through to this podcast.
Thank you. The pleasure was all mine. I'm so humbled. And thank you so much, RK, for having made the time.
Thank you, Sidi. Thank you.
Cheers. Over and out.
Thank you.